Jeff Santoro, you and I have been talking a little bit about Texas Instruments. The stock's down like 24% so far this year. You wanted to have a conversation with me, take a look at the business and find out if this is a stock that it's time to buy on the dip or there are concerns investors need to take a look at.
Yeah, it's one I own. It's one I'm interested in potentially buying more of. I know it's cyclical. It seems like we're in the down part of that cycle. So I wanted to have a conversation about it today.
All right, let's dig in. Before we do, though, just a reminder this video is sponsored by The Motley Fool. If you're looking for even more great stock ideas, please go to our special link, fool.com/the smattering. Motley Fool is going to give you its 10 best stocks to buy right now. Be sure to check out that link after this video. Okay, Jeff, again, it's really interesting, right? Because this is a semiconductor manufacturer, and you think everything that's going on, look at NVDA, Taiwan Semi, so many semiconductor stocks right now are actually doing pretty well, but Texas Instruments down. It's the 25th of October. We're recording this after market, and stock's down 24% this year. My question for you, Jeff, why is the stock down?
I think what we have to remember with Texas Instruments, like I mentioned a little earlier, is it is a cyclical business. So you're going to see times when things are going well, quarter after quarter, revenue's growing, and then you're going to see the opposite. And it feels like right now we're in the downside of that cycle. So just some quick numbers to put on it. They just released earnings a day or two ago. Revenue was down 14% year over year. And that follows a quarter when it was down 13%. The quarter before that, it was down 11%. The quarter before that, it was down. So we are seeing it trend in the opposite direction in terms of year over year revenue growth. At the same time, we've also seen gross margin start to slip. That was 62.1% in this quarter. Just to put that in perspective, in September, the September quarter of 2022, it was 69%. So that's down percentage
Nice.
points over the course of a year. So it just seems like we're in the down part of the cycle. And that's the thing I want to have the conversation about. Is this something investors should be worried about, or is this something investors should be excited about? Because whenever you buy a cyclical business, the trick is to buy it when it's low and hold on to it or sell it when it's high. So what are your thoughts on it?
So I think there's a couple things going on. So number one, we could almost turn it into a drinking game. The number of times that you and I are going to say the word cyclical in this video, but it's really true. But again, I mentioned NVIDIA. The stock's done so well this year. This is again that NVIDIA's fabless. They design semiconductors, and then Taiwan Semi is their manufacturing partner. Both of those stocks have done relatively well this year because of largely AI and demand for chips that can handle AI. We've seen more and more companies really focus their capital investments on developing their artificial intelligence around generative AI. Texas Instruments does something completely and totally different. They're an analog semiconductor company. So again, you look at those revenue declines, it seems like in this time that doesn't seem like it would be logical. But again, they have really no direct exposure to making chips that are tied to AI.
They're doing the chip there. My colloquial way of putting it is they make the dumb chips, right? So where NVIDIA is helping make chips that are going into AI and data centers and autonomous driving and all that kind of stuff. Texas Instruments is making the chip that goes in your microwave or your refrigerator or that makes your alarm, the clock on your nightstand work. So it's a totally different world of semiconductors with Texas Instruments.
The key that's really important that sometimes gets overlooked though is that is as much as their chips are the dumb chips, and you named a few of like the end use cases, their biggest markets are like industrial users. You think about industrial machinery, and even those high end advanced digital semiconductors all still rely on analog semiconductors because the analog semiconductors are the way that digital semiconductors and the way that electronics interface with the real world. So you think about voltage, power, getting power in and out of those devices. You press the brakes on your car, there's a semiconductor that's involved in making maybe the brake actuators work for some, like the fly-by-wire cars that don't have as much physical cabling, making the lights work, that sort of thing. Getting the signal. So you're watching this on a smartphone right now, or you're watching this on a computer screen, and analog semiconductor is playing a big role in getting that digital information from your video card to a visible way that you can interact with it here in the real world. So that's what's going on with TI. Now, here's the key. The things that are affecting their business, as much as automotive has actually been relatively good, it's that industrial part of the business that has been weak. And I won't say there's concerns about that, but there are reasons for investors to at least be mindful and cautious about it. Because as much as we've seen interest rates skyrocket, a lot of companies are having to reevaluate their capital plans, right? Because cost of capital has gone up. Maybe a company that 3 or 4 years ago had planned some pretty aggressive capital expansion. Now the cost of money's gone up enough, they're having to revise those plans, and maybe they aren't going to spend as quickly. So that could play some role in impacting Texas Instruments results, at least in the near term. But over the long term, Jeff, I think the reality is that Texas Instruments is so dominant on there's a lot to like. So again, thinking about on the digital side, you have the fabless companies like NVIDIA that design the chips. And then they go to Apple. Again, they're basically a fabless semiconductor company too. They do a ton of their design work. And then they go to the contract manufacturers to do the actual manufacturing of the semiconductors too. And then there's lots of different channels that people go through to get their product designed and made, right? If you're working with NVIDIA to build a chip and then they go to the manufacturer, there's all those processes. If you're designing a product and you need an analog semiconductor, you can go on Texas Instruments website and probably find the exact product you need that fits your specifications, basically right there off the virtual shelf, and buy it directly from the manufacturer. They have something like 100,000 different customers. It's remarkable how fully integrated that they are. Jeff, there's one other thing that's going on that I think is really important to understanding what's going on with Texas Instruments. The reason their profits are maybe taking a bigger hit than their revenue decline is showing. First of all, it's normal for most businesses for that to happen because you get operating leverage to a certain point. Once your revenues reach a certain point, every dollar of revenue is worth an incrementally larger amount of profit. So we're seeing a little bit of loss of operating leverage here. But what we're also seeing is the company's commitment to continue spending to build one of its most important competitive advantages, and that's the large format that they use in their fab when they're manufacturing these chips that gives them incredible cost advantages. And that's a 300 millimeter wafer versus 200 is typically this has proven to be the standard. So they're building their new fabs and they're converting some of their existing fabs to 300 millimeter wafer size. And that is a substantial reduction over time in their actual manufacturing cost. You got to spend the money now in capital to get there. So it's affecting their cash flows. And they're, as they add operating costs, as they begin to bring these facilities online, it weighs on their operating expense, it weighs on their cost of goods sold up front until they get more scale before it turns into incremental profit. So I think looking over the long term, Jeff, I think the companies, they're delivering basically as they told us they would, right? Management's not having to make excuses because they're missing targets or any of that kind of stuff. They're basically operating as they said they would. Even within the down part of the cycle, they're continuing to focus on the long term for the business that matters the most. And I think that should really be reassuring for investors who are thinking about looking at an investment in Texas Instruments.
And just to put that in perspective, look, going back to even 2018, 2019, their operating expenses are about 20% of their revenue pretty consistently. That dipped into the below 20% over the really kind of boom quarters we saw in 2021. And now it's back up to about 20%. It looks like their profits are falling, but it is just because of that investment that they continue to make. They invest pretty continually throughout their history. So that's just something investors should know when they look at the bottom line.
One last note I want to make here, Jeff, before we wrap up the video, thinking about from a valuation perspective, is Texas attractive, right? Because again, we've seen the stock price come down a lot. We've also seen earnings come down a little bit too. But even with the earnings decline that we've seen, shares trade for about 17 times trailing earnings. And a lot of that trailing period has been this weaker part of the market. If you look at it historically, that's a pretty reasonable valuation. And it's actually on the cheaper side of where it's traded over the past decade. Then the other thing you can use as kind of a proxy for valuation is dividend. Dividend yield's about 3.6% right now, which historically that's certainly on the higher end of where it's been. You put it all together, Jeff, you think about where we are in the cycle, think about the risks to the business, think about the long-term opportunities and management's focus, valuation, put it all together. Jeff, I think Texas Instruments is a buy right now.